Welcome to CalCPA's Disaster Recovery Series, Episode 4, the final and perhaps one of the most crucial episodes of our disaster recovery series. Throughout this series, we've extensively discussed the significant tax relief available following a federally declared disaster, a status typically triggered by an official IRS news release in conjunction with a FEMA declaration. But what happens if your community, while undeniably impacted by a severe event, perhaps localized flood, a tornado that missed the federal declaration criteria, or a wildfire that didn't meet the threshold for a broader federal assistance, isn't explicitly named in one of those federal announcements? This is a common and often incredibly frustrating scenario for affected individuals, but it's vital to understand that it doesn't automatically mean that tax relief is not available. Understanding the nuanced layers of disaster declarations is absolutely key. For taxable year beginning after December 31st, 2025, the rules for deducting personal casualty losses will expand significantly, extending relief to individuals affected by both federally declared and certain state declared disasters. This is a change from the 2018 through 2025 rules, which generally limited personal casualty loss deductions to those resulting from federally declared disasters. A federally declared disaster is issued by the President through the Federal Emergency Management Agency, or FEMA, and triggers a range of federal assistance, grants, direct aid, and various IRS tax relief provisions. This may include extended filing and payment deadlines and the ability to deduct casualty losses in the prior year for a faster refund. A state declared disaster, while important for mobilizing state level aid and resources, did not previously trigger federal tax benefits. Under the One Big Beautiful Bill Act, enacted in July 2025, for taxable years beginning after December 31st, 2025, certain state declared disasters will also qualify for federal casualty loss deductions if the event meets severity thresholds and is recognized by the Treasury Department. For qualifying qualified disaster losses, which starting in 2026 may stem from either a federal or eligible state deduction, the 10% of AGI threshold for deductibility is eliminated. The per-casualty floor is increased from $100 to $500. Taxpayers may claim the loss even if they take the standard deduction, and losses are generally claimed in the year that disaster occurs, but for federally declared disasters, the prior year claim option for accelerated refunds still applies. This option does not currently extend to state-only disasters. For federal income tax purposes, the One Big Beautiful Bill Act meaningfully broadens access to casualty loss deductions, particularly by eliminating the AGI floor for qualified disaster losses and adding certain state declared disasters to the list of eligible events. This expansion ensures that more taxpayers can access meaningful tax relief after severe disasters, regardless of whether the federal aid is declared. However, not all states conform to these changes, and careful review of your state's rules are needed. For example, California does not conform to the changes made by the One Big Beautiful Bill Act with respect to casualty losses. This is precisely where state-specific programs and deadlines become incredibly important and can provide crucial relief. Many states have their own robust disaster relief programs that operate independently of federal declarations. These can include state-level tax relief. This might encompass property tax reassessments that reduce your property tax bill if your home was damaged, specific state income tax credits, or deductions tailored to disaster losses that might have different thresholds or limitations than federal rules. This can also include grants or loan interest loans. State emergency management agencies or other state-funded programs often provide direct financial assistance to individuals and businesses impacted by disasters, even if it's not a federally declared area. These grants or loans are designed to help with essential needs, repair, and recovery. This can also include extended state tax deadlines. Similar to federal extensions, state tax authorities may also postpone various filing and payment deadlines for state income, property tax, or other state-specific taxes. It's absolutely vital to proactively research and understand these state-specific programs, as they can provide substantial assistance even without federal involvement. Always check the official websites of your state's emergency management agency and your state's tax department for the most current information, application processes, and crucial deadlines. Another critical area, regardless of the declaration status, is the careful management of insurance claims and their impact on tax reporting. The amount of insurance reimbursement you receive for damaged or destroyed property will directly reduce your deductible casualty loss. Any portion of your loss that is fully reimbursed by insurance is generally not deductible. Conversely, if your insurance payout exceeds your adjusted basis in the property, you may still have a taxable gain, even if your county wasn't federally declared. You will need to accurately report these insurance payouts on your tax return. Remember, there's a distinction between being reimbursed for your loss and realizing a gain from a casualty. If you find yourself in this particular situation, you might explore alternative ways to claim casualty losses if the property was used in a trade or business rather than solely for personal use. Business casualty losses generally have different deductible rules and are not subject to the same AGI limitations as personal casualty losses, potentially offering more favorable tax treatment. For all of these avenues, proving eligibility for deductions and relief programs is paramount. This means your documentation must be incredibly thorough. Photos and videos of the damage, detailed inventories of destroyed property, receipts for cleanup and repairs, insurance claim records, and any correspondence related to the disaster. The more evidence you have, the stronger your claim. Ultimately, working with experienced tax professionals is your best course of action. They possess the nuanced knowledge to help you understand the complexities of disaster declarations, identify all applicable federal and state tax relief provisions you may qualify for, and guide you through the intricate process of proving eligibility for any deductions or programs. They can also help you strategize on how to manage any casualty gains and ensure your overall tax compliance during a challenging time. And remember, sometimes an area might receive a disaster relief designation later than initially expected. If your area eventually receives such a designation, your tax professional can advise you on the steps to take to amend previous returns or leverage new relief options that become available retroactively. Don't let a lack of immediate federal declaration deter you from exploring every possible avenue for recovery. Proactive steps and professional guidance can make a significant difference in your journey to rebuilding. And this concludes our CalCPA's Disaster Recovery Series. Thank you so much for watching, and we hope you have some key takeaways on the various tax implications following a disaster declaration.